In this chapter, we'll be discussing retirement plans, as well as other tax-deferred annuities, and as well as education savings plans. So the government incentivizes taxpayers to save for retirement by providing tax-deferred earnings in qualified funds, as well as some tax-deferred and tax-free plans that encourage taxpayers to save for their education or that of their children or dependents. Various kinds of retirement plans include the employer-sponsored plans and the individual-based plans. We'll be discussing both in this video. First, let's discuss some of the terminology we'll be using. One is annuity, and that is generally a series of payments, generally equally spaced over time. Beneficiary is the person who would receive the funds, for example, or distributions from a fund. Contributions are generally made at the front end and create the fund. So these are dollars that are added to the fund. Distributions are dollars taken from the fund, often at retirement for a retirement account, or education for education, usually at the time the student attends college. A donor can be someone who transfers funds, for example, to another taxpayer, related taxpayer, out of goodwill and freely given. Tax-deferred retirement accounts or other plans, we'll talk a little bit about those, such as 401ks and IRAs. And trustee is someone who will manage the funds in a trust. Often it's the same person who contributes to the trust. So tax-deferred certainly does not mean tax-free. It just means that the payment of the taxes on the funds or earnings of the funds will occur later. There's kind of a general rule if we're wondering whether or not a distribution from a fund is to be taxed. And if the contributions are untaxed, then when they are contributed, of course, then they are taxed when they are distributed. So, for example, a contribution to a traditional IRA may be untaxed, and if it is, then the distributions would be taxable. Conversely, previously taxed contributions are not taxed on the distribution. So another example of this would be for IRAs that are of the Roth IRA type, and those Roth IRAs are funded by contributions that are taxed. So the distributions on the other end of the fund are generally not taxed. And as it says, the contributions can provide a tax deduction to the person making the contribution to the funds. As I mentioned earlier, there are various employer-sponsored retirement plans. For example, one is the Simplified Employee Pension, or SEPs, are created by the employer, and they contribute to an employee's IRA. Maximum contribution of these simplified employee pension plans is the lesser of 25% of the comp, up to $770,000 or $54,000. Now, simple plans, here the employer creates an IRA or 401k for the employee, and then the employee can contribute a certain percent up to a maximum of $12,500 per year, and you can add an additional $2,500 if you're age 50 or older. So these simple plans are designed really for very small employers who want to provide a retirement benefit for their employees. The employer's options on these simple plans, they can either match 3% for all employees or 2% for eligible employees. And usually that eligibility is often based on vesting rules. Getting into the now individual-sponsored retirement plans, traditional individual retirement accounts and IRAs are the two common types of individual plans. Contributions are limited for 2018 to $5,500 or 100% of compensation, whichever is less. If you're age 50 or over, you can add another $1,000 to this annual contribution limit. Individuals that are covered under an employer plan, generally there's a limit to the amount you can contribute to deductible plans like a traditional IRA. and these limits are phased out based on adjusted gross income. So, for example, if someone had a traditional IRA, then the deductibility of those contributions would phase out when AGI reaches $99,000 for married and $62,000 for others, and would fully phase out. That is to say, none of the contributions would be deductible when married filing joint taxpayers reach $119,000 in adjusted gross income and $72,000 for others. If the taxpayers are married filing separately, however, the phase-out begins at zero contribution, so none of the contributions in that event would be deductible. And again, this would apply to traditional IRAs. They can, however, still make a non-deductible contribution up to the limits I specified earlier, $5,500 or $6,500. So they can still contribute to a traditional IRA. It just won't be deductible if these AGI limits are exceeded. And they have or are covered under an employer plan. There is no AGI phase-out if the individuals are not covered under an employer plan. This only applies to those that are covered under such a plan. If married people are both employed, they each can contribute up to the maximum dollar limits, $5,500 or $6,500. If only one spouse is employed, however, and the other person is not covered under the employer plan, the other non-employed spouse can contribute up to the maximum for his or her plan as well. I said traditional plans, you can deduct, if you qualify, your contributions. Under Roth, however, Roth contributions are not deductible in any event. However, when the distributions are made or the withdrawals are made, those distributions are not taxable. The contribution limits are the same as traditional IRAs, $5,500 and $6,500. Here the phase-out starts at $186,000 for married filing joint and $118,000 for single or head of household. Again, zero. There's a phase-out, at $0 for married filing separately. The range, which is the denominator in some of our calculations that I'll be demonstrating in the next video, is $10,000 for married filing joint and $15,000 for all others. So, for example, for married filing joint, if the phase-out starts at $186,000, it would end at $196,000. $186,000 plus $10,000. So there can be no contributions to a Roth IRA if the AGI for married filing joint is greater than $196,000. There are advantages and disadvantages to each plan, traditional IRA and Roth. As I said, the contributions are deductible for traditional IRAs but not for Roth, but the distributions of traditional are taxable, but IRA distributions are not if they're Roth IRA. Government, as I said earlier, also incentivizes taxpayers to save for education. So contributions, however, are not deductible to these plans, but the account grows tax-free, and that's, as we said earlier, is different than tax-deferred. As long as the funds in the account are used to pay qualified higher education expenses of the beneficiary, then the earnings through the years in those accounts are never taxable. And any person can establish a fund, and this CISA is the Coverdale Education Savings Account, for any person, either him or herself included or somebody else. The limit on these CISA contributions is $2,000 per beneficiary, not per taxpayer. And that's from all sources combined for the benefit of the student or the future student or the beneficiary. Here the contributions are phased out when AGI of the contributor reaches $190,000 married filing joint or $95,000 for others. Again, the phase-out ranges are $30,000 for married filing joint and $15,000 for all others. So again, going back to our example of married filing joint, when the taxpayers have AGI of $120,000, then the contributions are completely phased out. And there's a general rule that distributions are taxable if the contributions were deductible. And we said earlier with a traditional IRA, if you made deductible contributions, then when you receive the distributions, they would be taxable. We'll talk a little bit about the simplified method when some but not all of the contributions were made with previously taxed dollars. Distributions may be partially tax-free and partially taxable, and we'll talk a little bit about, and in fact I'll demonstrate some of that, this concept especially in the second video. So in the simplified method, for cases where distributions are partially taxable, here, and again, the best way to really understand this is to go through some examples, which I will in the second video. But we want to determine the number of anticipated payments using either single life or dual life tables in the text. And then we'll determine the total contributions from previously taxed dollars. And then we'll use a fraction of the previously taxed dollars divided by the number of payments which we got from the table. And then this fraction will represent the portion of each payment that will be tax-free. And again, the only way for this to really run through this, where it would make sense, is to do some problems. Some plans have a required minimum distribution that must begin by April 1st of the year the taxpayer reaches age 70 and a half. In fact, there's really stiff penalties if these distributions, for example, from a traditional IRA, are not made by this time, by the April 1st of the year the taxpayer reaches 70 and a half. The minimum distribution, or the required minimum distribution, is based on life expectancy tables, and these are normally from Table 3 in the text. And Table 3 in the text is found at the end of the chapter, and it's found on page 11-28. And we'd use these IRS tables to determine the life expectancy for each year. I mentioned earlier that distributions or payments from an IRA account that is a Roth IRA are generally not taxable. There is an exception. If earnings are taxable, not the contributions part, but the earnings part of each contribution are taxable if they're withdrawn from the Roth within an initial 5-year holding period. Coverdale education savings accounts, its distributions, as I said, are tax-free if they're used to pay for qualified education expenses. However, if a taxpayer is taking advantage of the Coverdale account, they cannot also take advantage for the same education expense or same education dollar paid of the American Opportunity or Hope or Lifetime Learning Credit. So, in other words, we can't double up the same benefit on education expenses, but we can combine them as long as we're not using the same credit or deduction or the CISA for the same dollar of education expense paid. I'm going to go back and give an example of that Coverdale education expense account. For example, if out of the Coverdale education expense, tuition and books were paid, but other expenses like services and fees were paid out of another account that was previously taxed, then the latter could qualify for the American Opportunity or Hope Lifetime Learning Credit, since those payments did not take advantage of the tax benefits of CISA. If we take out funds out of these qualified retirement plans, for example, there is a 10% penalty. There are some exceptions that apply on page 11-19. And, for example, if you take funds out early out of a retirement account and they're attributable to a disability, then you would not have to worry about the 10% penalty. You also don't have to worry about a penalty if the funds are rolled over from one qualified retirement plan to another. Generally, often it's advised that these funds be rolled over directly between trustees or between managers of the funds or accounts, rather than distributing a check to the employee, for example, or taxpayer, and then they reinvest within 30 days. Either is acceptable, but in order to avoid the penalty, the rollover funds have to be in the second or rolled over into the second account within 60 days. We talked about an annuity as a series of payments pursuant to a contract, often an insurance contract. Annuities now are partially taxable. The amount contributed into the annuity, for example, the purchase price of the contract, the portion of the payment later received that's attributable to the contribution or the purchase price is never taxable. However, the earnings on the annuity often is taxable. So the expected return would be the total amount that the recipient anticipates receiving over the annuity contract, and that includes amounts contributed and the amount earned in the contract. And these contracts are for generally a limited life, and the expected return would be the periodic payment times the number of payments. And again, those number of payments are often determined by life expectancy tables. We used to call these mortality tables that are found in the text. So on the next video, I'll go through then some examples that discuss and exemplify some of these calculations.